Good evening, everyone. Time for another silver update. This is the daily chart of silver provided by netdania.com. You can click on the link below. This is actually the close-in view. The reason why I'm doing this, I wanted to show you we're just getting a crossover in the daily. If we pull this back out, you can see that this is really the trend lines for that very, very large pattern that we've been looking at. Now, the trend lines that I had drawn, especially on the bottom, which has a whole bunch of touch points here, you can see it's 6 to there, and then we get it right here, and you can see we clearly went below it, but we're back up above it, and also that the MACD is beginning to cross over to the upside. Now, most technical traders would have got a significant sell signal here with this breakdown. Now, admittedly, that's not a breakdown of traditional support and resistance, because that probably would be this line right here, just because there's congestion before we hit that price. Much more likely to have a free fall in this area, just because there's not as much support. There wasn't as much action at those prices. So this area that we're at here actually has a lot of price congestion. You can see all through here, in here, both of these, and so the breakdown below this trend line is not as technically significant as a breakdown, say, below this line here or this 25 line here. But it is interesting that we seem to have a bounce off this and we're rallying. Sometimes when you get breakouts of these pennant formations, you can actually have fake outs as well. Here's a significant fake out here, and this could actually be a fake out here. We could turn and go this way from here. So it's hard to know when you've had a confirmation or breakout of a pennant until you've really moved significantly beyond that. If we go back to the weekly, then of course it's very easy to see that this one here was clearly a breakout, and that pretty much took off and never looked back. But you really don't know if you've got one of those until afterwards, and you can look back on it. So I pointed out that the MACD seems to be rounding up on the weekly. As the daily begins to cross over, we may get that. We're looking for a move just back to the zero line, just to get some kind of confirmation that this thing has bottomed, which no one knows for sure, but it appears to be forming that very, very large formation. So let's go over to the question of the night. That's actually going to be the topic of the night, and there's a lot to talk about there, so I wanted to jump right in. And this, of course, is the LIBOR scandal that's breaking over in the UK. And of course, the take is going to be that nothing is as it seems. I certainly don't have all the answers on this and what's going on here, but I just wanted to try to delve into it a little bit and maybe chase some things down the rabbit hole and see where we come out. So here's the question from Anthony about the LIBOR scandal. Here in the United Kingdom, there's a developing scandal involving the fixing of the London interbank offered rate and the European equivalent, the Euribor, by a number of banks in the City of London. This doesn't seem to have caused much of a ripple in the United States. Why do you think this is? It seems to be the smoking gun that many people are looking for on both sides of the Atlantic. So, very good question. I wanted to start by examining the LIBOR. Of course, the LIBOR is the London Interbank Offered Rate, and this is from Wikipedia. It's the average interest rate estimated by leading banks in London that they would be charged if borrowing from other banks. It is usually abbreviated LIBOR. It's officially from the British Bankers Association. LIBOR rates are calculated for different lending periods, and there's, I believe it's 15 different lending periods. Goes a little bit into the history. LIBOR is defined as the rate at which an individual contributor panel bank could borrow funds were it to do so by asking for and then accepting interbank offers in reasonable market size just prior to 11 London time. This definition is amplified as follows. The rate each bank submits must be formed from that bank's perception of its cost of funds in the interbank market. Contributions must represent rates formed in London and not elsewhere. Contributions must be for currency concerned. Rates must be submitted by members of staff at a bank with primary responsibility for management of the bank's cash. The definition of funds is unsecured, etc. So, the first thing that really jumps out at you when you start looking at this LIBOR is it seems to be a lot like the gold fix. If you remember, they'd go to old Rothschild and ask him to set the daily gold fix. So it's a very subjective number, and as we delve into it, we're going to see how subjective it really is. So let's go to a Q&A and take a look at what this rate is and how it's set. But we'll read some of the introduction about the story. This is from the Telegraph on Wednesday, June 27th. Barclays has been fined £290 million to settle claims that it's manipulated the London interbank offered rate, LIBOR. We explain what LIBOR is and how it affects households and companies' borrowing costs. What is LIBOR? LIBOR stands for the London Interbank Offered Rate. It is the average cost of borrowing for banks calculated daily. That average is taken as official LIBOR, which is used to price trillions of pounds of loans, financial products across the world. The rate is worked out by asking banks to submit their borrowing costs, discarding the top 4 and bottom 4 rates. Now we're going to get some more clarification. It has more to do with the size of the bids, but again, note there that they're discarding the top and bottom 4. That's going to raise some flags right there. And taking an average of the rest. There are in fact several LIBOR rates measuring the cost of borrowing for different lengths of time, of which 3-month LIBOR is seen as the benchmark. Just to complicate matters, LIBOR is also calculated for different currencies, of which Euribor in euros is one. Don't I know LIBOR from somewhere? You might remember the term from the Northern Rock crisis, having effectively matched the Bank of England's base rate for years. LIBOR started creeping up after the credit crunch struck. As a visible daily metric, it became the instrument by which financial stress was measured, bringing the arcane technical term into households a bit like quantitative easing today. Stress could be seen in the cost of LIBOR over the base rate, which peaked in October 2008 after the collapse of Lehman Brothers at 1.68 percentage points. In April of this year, the spread was back down to just 0.56 points. So what did Barclays do? From 2005, traders in its investment bank started asking Barclays' treasury function to submit artificial LIBOR rates to benefit their positions and boost profits. And from late 2007, around the time of the run on Northern Rock, orders started to come through from senior management who were worried that high LIBOR rates were making Barclays look risky. To combat the perception, Barclays started deliberately understating their LIBOR rates. But what does it mean for me? And then it goes into the impact of it. So I want to examine this impact that Barclays would have, but I want to take one more explanation of this, and then I'm going to discuss it. This is a video that's available on YouTube, and it's just kind of a tutorial about LIBOR. I want you to listen to what this gentleman says.
The BBA method of eliminating the upper and lower quartiles of quotes received from a panel and then taking the average of the remaining quotes prevents BBA LIBOR from being influenced by outlying quotes, such as the largest and the smallest quotes. And it also prevents BBA LIBOR from being influenced by any one bank, as the average is based on quotes from several banks. To ensure transparency, the quotes from all panel banks are also published.
So you can see that the LIBOR rate, by definition, cannot be influenced by a particular bank. if a particular bank puts its LIBOR rate quote outside of the band higher than the average quartile, highest quartile, or lowest quartile, then that bank's quote is going to be thrown out. So the question is, why is Barclays being accused of manipulating the LIBOR rate, which obviously, by definition, it cannot do? And the second question would be, why do you have such a very important interest rate, which apparently as much as $300 trillion worth of derivatives are dependent upon, is being determined by people reporting something, not a loan that they got, but a report of what they would get if they got the loan. So this whole thing is so fishy and so ridiculous that this is not a free market. This is, this is when they're talking about somebody manipulating the market, what they should say is that LIBOR is manipulating the market. The very essence of LIBOR is market manipulation. It's a non-market rate because it doesn't freely trade. So it's based on rumors, and it's based on the honesty of people who are quoting it. So the whole story stinks to high heavens, and that's the reason why I decided to do a little bit of digging further. Now, if you remember Barclays, Barclays has been involved in a lot of other stuff in the past, but before we dig into Barclays, I want to bring you to a story that hit back in May 21st, and this was a story about Barclays selling its $6.1 billion stake in BlackRock. Now, this is Lawrence Fink, and we've covered him before, a real shady character. And then there's, of course, Robert E. Diamond. So we've got our Diamond over there in England, and we've got our Diamond over here in America, and a couple of shady characters. But what's so interesting about this is that Barclays had to sell its $6.1 billion stake in investment management firm BlackRock because of the new Basel III requirements. And I'll read to you a little bit here. In coming years, banks will be required to adapt to the latest rules from Basel Committee on Banking Supervision, known as Basel III. The regulations would make it more costly for Barclays to hold a stake in an investment firm like BlackRock because it would have to set aside capital against the stake to cushion itself against any decline in the value of that holding. Banks are selling assets to increase their capital buffers amid regulatory changes. Barclays, based in London, is also in the middle of reorganization aimed at improving profitability. The bank cut jobs and has been exiting business operations that did not meet certain targets. So the first flag that comes up, of course, when you realize that the whole idea of accusing Barclays of manipulating the LIBOR rate is absurd on its face, because the LIBOR is designed so that no one bank could manipulate that rate. Secondly, the fact that LIBOR itself is a very shady practice to begin with. But then we have this story and these two characters. And if you remember on stories that I've done in the past, the thing that Barclays and BlackRock have in common is the SLV. BlackRock is they're not the custodian. I forgot the term of it. It's in here. Anyway, you'll have to look at my video in the past about it. The custodian, one is JP Morgan and one is BlackRock. But Barclays was the original, and they actually sold it to BlackRock. And so this is a story on Zero Hedge back in April of 2011, where BlackRock found it necessary to come out and disclaim that there's anything fraudulent about the SLV. And of course, you know the saying don't believe anything until it's officially denied. So it certainly makes one wonder why Barclays is Mr. Diamond overseas with Barclays is being taken to the woodshed, and over here in the United States, Mr. Diamond is being taken to the woodshed. And the one thing that all these shady characters have in common, Mr. Diamond, and Mr. Fink, is silver. And of course, we know the manipulation of silver through the SLV. What did Barclays do? Who did they make mad? We don't know. But clearly, the story runs a lot deeper, and I suspect that it has something to do with the SLV and silver, and ultimately it's going to do with the blow up of all these derivatives when they finally do blow up. So back to the silver chart. We still have an opportunity to stack here. The 27, anything in the 20s is just an unbelievable price. There's still junk available. There's still a lot of silver available. Are we going to get a bottom here? I really can't tell you. There's some support around 25, but really firm support is around 22. It does look like the MACD is rounding up on the weekly. It certainly crossed over on the daily. So odds are, in my opinion, you're not going to see anything below 25. So stacking now may be a good idea. And we'll talk to you next time.